Tiger Trades here. Just decided I'm not gonna rehearse a bunch for this resistance and take profit, stop loss video. Looking at support and resistance, looking at Fibonacci levels, how to determine how to enter and exit trades. So you kind of have to identify levels of resistance and levels that are very important. So levels where there's lots of volume, moving averages, gaps. So for instance here, you want to kind of set a floor. So whenever you see something kind of stop off here where kind of, it bottomed and then came back, that's one of your support levels. So this was a support level right here, and so is this right here. So is this. But they become both as the ETF index, whatever stock moves, your take profits become your stop losses, and that's kind of just how it goes. So for instance, this once was a stop loss back here. This was a stop loss back here, but then now it's become a take profit. That's a take profit level. So one of my levels last week, which I guess I wrote it down on my note card wrong, I wrote it on my note card 373.56 on the SPY, but I guess it was really 373.96. It still hit it anyways, in my other level, but sometimes to identify the shorter time frames. Oh, this is all kind of marked up wacky. I'm gonna clear it in a second and just go straight from a fresh canvas. But if you look at it like a smaller time frame, for instance, you can see where these levels are at. So you see it battles with this level. So when you're going in a trade, that's kind of like your exit point. So you're not willing to lose any more than this level. So say you enter here and you time it wrong right here, and then it goes down, you get stopped out and you don't lose as much money, because then you would have woken up Monday morning totally screwed, So that's just kind of how you got to do it, to stay proactive. So let me go to the SPX because I have this more marked up. So this is kind of one of the main ways I figured out some of the levels to go for. These gaps. Once again, I've gone over this gap before. I know technically not a gap, but that was the fourth or fifth largest intraday reversal for the S&P 500 of all time. So yeah, I'll count that. But yeah, see, this is kind of how I determine my level, and you can see about 373 right there. So for the SPY, the ETF, you actually just move the decimal over. So see how that's 373.96 if you move the decimal over to the left. So that was my level right there, and that was my target. So it filled it here, and then it's always going to battle back with that. 9 out of 10 gaps fill, 90%. That's ridiculous. So it's a very valid tool to use. I'm freaking getting tired of this ad-free version, but I'm not trying to pay for this bullshit. Anyways, let me just clear this motherfucker off. Boom, boom, boom. So say you were looking at the daily and you wanted to define some areas for yourself. So what I would first do is I like to start off with a Fibonacci. So I'll go to the peak and come down to the bottom, and then I'll extend it so I can get a little bit better idea of what's going on and what's going to happen. So I extend it out a little bit, and then here this gives you a bunch of levels. So extended levels where it could go in the future, and the current retracement, and this is what I just marked as the most recent bottom. I find Fibonacci levels are easier to use and more defined time frames, if you will. So like for instance, from the beginning of the year to now, So see, it always kind of hangs on to a level. It's kind of ridiculous what Fibonacci does. But so these are some levels here where you can see, like, okay, you might want to take some profit here because then it's probably going to battle with that for a second, and you don't want to get theta burned and theta clapped. And like, look right here, it hits the 200-day moving average and just bounces down. It hits it to the penny, I swear to God. Let's see, 431.57 is the 200-day. The high was 431.73, so barely made it, like a couple 15 whatever cents above. Who cares? So anyways, with the moving averages, you can see the yellow is the 200-day. That's longer term. It's a very key metric. A lot of people use EMAs, exponential moving averages. I don't really care for it. I've tried doing the 8 EMA and 21 EMA. I didn't really trade that well off of it. I'm more of a classical guy, if you will. So I like the classical moving averages, and I usually just pay attention to the dailies. The hourlies and whatnot can help you in shorter term trades, but longer term trades, you really want to pay attention to the daily or the weekly. So for instance, here you can see that this is kind of a level for what. Before I cleared this, I'm pretty sure this was about a level I had for a stop loss. So you see that's the 20-day moving average. So that's a shorter term thing, and you can kind of see it fights it. It goes up, comes back down, and it keeps fighting with it. So like if you're trading, like for instance, if you got on Thursday, you probably want to be out right here. You probably want to be out even sooner, because then you just don't want to get caught in trades nowadays with how choppy the market is. So you have to be nimble and quick and in and out. That's really the only way to be successful nowadays, especially with all this chop. I mean, everybody is a genius in a bull market when everything's going up and liquidity is free and cash is free and there's zero interest rates. So companies that make no freaking money can go through the roof. But so I like the Fibonacci. I like to look at past important levels. Oh yeah, I forgot. I'm not paying. Don't do that. I'm not paying for the freaking paid for version, so I'm gonna do. I don't have VWAP anymore. Or I mean, a visible. What's it called? Visible range volume profile. So yeah, I don't have that right now, but I'll do the abbreviated version. So if I go from where this is the more fixed, which I actually kind of prefer. So if I go from here to the bottom, you can kind of see where a lot of the volume is. I'm going to turn off the moving averages so you can see this better. Actually, I'll even delete the Fibonacci. Screw it. So here you can see where a lot of volume was traded in the past since then. So look at that. On the money. That is where a lot of volume was traded. So when it hits that level, people are getting out because they're scared, or that's where they bought in and they're just trying to break even. So in this type of environment where we've went from extreme bullishness to extreme bearishness, this is when people a lot of people were buying in right here. So the second it went down and came back to it, everyone's like, oh, screw it, get me out. And well, they were right. They were right. So that's why you use these levels. So anyways, with VP, VR, let me touch on VWAP actually, because I actually just mentioned that. So VWAP would be volume weighted price average. Volume weighted average price. I always do that. Whatever. Who cares? So this is another level that's very important. Very similar to the visible volume profile or whatever it's called. I would just call it VPVR or whatever. Let's move this up here. Oh, that is the top. So as you can see, it becomes so here it becomes prior resistance turns into support because it supports it for a second, not really, breaks through again, and so right now this is really acting as resistance. So as you go along and you're making trades, take profit here. Take profit every time it hits there. I mean, keep your longer term trades on, but don't get cocky and think you're going to just blow past this, because look what happens every time it tries to blow past it. It gets torn back down. So that's when you exit. And then, like, to be honest, I do like parallel channels a lot. So these are actually extremely good indicators of what the current pattern is. So I can just like do something like that, and like you can see Carter Braxton Worth from Worth Charting, who's amazing, who's one of my I look up to him. You know, he's smart. I follow his work. So anyways, he always likes to say to the penny. So you can see it almost to the penny every single time, bounces off of there. So usually you want 3 points to connect. I got more than 3 points here, but usually you want 3 points to connect a trend. But as you can see, it really follows it, because there's a lot of algorithms, there's a lot of chartists, there's a lot of technicians out there trading with a lot of money that pay attention to this stuff. So these levels are actually valid and important. And you know, just like I said, look, you just gotta use the confluence of all these factors to really decide what you're gonna do and how you're gonna do it. You know, you can't just depend on one tool. I mean, I do ascribe to the theory and the idea that if you find your method, to stick with it. But I truly believe that you need to keep your eyes open for all indicators, all fear index, all that stuff, everything. You have to keep that in mind when you're placing trades, because I mean, like, you know, if you just stick with Wyckoff, you're going to get screwed. If you stick with Elliott wave theory, you're going to get screwed. If you use a little bit of everything and kind of like figure out a way to add multiple factors into your decision making, you can be much more successful than relying on one thing that's some honestly stupid theory, like for Wyckoff. I hate that. Sue me. Eviscerate me in the comments. I really don't care. But anyways, that's it. I really didn't even rehearse this. I literally have no notes in front of me. Happy Sunday. Have a good week next week. Let's get it. It's going to be important. Watch out for geopolitical issues. Happy trading.